Hey there YouTube. So in this video I wanted to go over how you record and calculate deferred tax assets and liabilities for a corporation. So in this example we're going to have the Form 1120 here for our fake C corporation, and then we're going to have a very simple example, the corporation's balance sheet, profit and loss statement, and how you compute the tax provision and ultimately get those deferred tax asset and liability accounts. Now, first thing to note is when you're computing tax provisions, they really only apply to C Corps. And that's because C Corps are entities that actually pay tax at the entity level, right? If you've got a pass-through entity, it's not subject to taxes directly, right? The owners are the ones that are paying those taxes. So you would really never really see a federal tax provision on a pass-through entity, right? So a Delaware LLC that's a partnership, for example. Okay, so we have an 1120 example here, and then I have an Excel spreadsheet with the balance sheet, income statement, and then a few other items that we'll need to compute this provision. So I'm going to just go over what's on this sheet to start with, and then we'll come back to a few items. So at the top here I have the balance sheet. Now this is the adjusted balance sheet after we record the provision. So I want to pause here for a second. We'll come back to this, and what we'll really want to focus on is the profit and loss statement first, right? So you can see on the balance sheet we have deferred tax assets, we have taxes payable. These items aren't going to be on your books already, right? At the end of the year, you're going to have to calculate the provision and then make an adjusting journal entry to get that on the books. So this is going to be the final version. Let's look at the income statement first, and then it will make more sense as to how those numbers got on the balance sheet internally, and then ultimately your tax return. So if we go down here to the fake landscaping company, their profit and loss for the year, customer sales $84,100, and they have a bunch of expenses here. Total expenses, pre-tax book income. So if you're in QuickBooks, this is what you would see on a pre-tax basis, right? What's important to highlight here is because we are recording a provision that's going to contain some temporary tax differences, I've highlighted the item here, right? So contingent bonus accruals, what would that be? Well, under US GAAP, there are certain items that can be deducted or accrued from an income perspective, but you might not be able to deduct those or recognize the income on your federal tax return, right? So under GAAP, if you have an expense, you record the liability and the expense when it's incurred and the dollar amount can be reasonably ascertained. It's a relatively low standard. So in this example, what we're saying is that, well, the workers in the company are going to get these bonus payouts. Right now we think it's going to be about $5,000, but under the terms of the payouts, we're actually not going to finalize the calculation until maybe January or February when we close our books. And so we're allowed under GAAP to record that accrual, but under tax purposes, we might not be able to deduct that, right? We might have to have a temporary difference to back that amount out in the current period, and then we can deduct it next year when it's actually paid. So that's the fact pattern that we're presented with here. So we have the landscaping company P&L. So this, again, is what it's going to look like in your QuickBooks file before you start making any changes. So now how do we compute the federal tax provision? Well, because this is a C Corp in 2020, the rate was fixed at 21%. So very simply, we take what is our pre-tax net income times 21%, and that's what we got, right? 4813 is 21% of the pre-tax net income. So if we book that on our financial statements, the adjusted net income or loss per books after taxes is now going to be 18,103, right? So it's the pre-tax net income minus the corporate income taxes. Now let's pause here for a second. This is your corporate income tax expense, assuming you have no permanent tax adjustments. If you have any permanent adjustments, this might be a little different. But for purposes of this example, we're just going to work with this one temporary difference up here. So we have the 4813 number, but we have to ask ourselves, okay, that's what's being recorded on the books, but is that actually what I'm going to pay in federal taxes during the year? And the answer is going to be no. And that's because when we do our federal Form 1120, we're going to have a temporary item. We're going to increase our net income by this 5,000 amount because we're effectively not deducting it in the current year. And so once we do that, the amount of taxes we're actually going to pay is going to be different than this 4,813 number. Okay, so let's scroll down a little bit here. And again, I'm going to flip back to the Form 1120 right after this, just so we can see how some of these numbers actually end up on the return. So when we're doing our federal income tax calculation, and for those of you in your mind thinking about Schedule M1, the page 1 of Form 1120, right, we have our pre-tax book income, but we're adding back a temporary difference for these accruals. And so our net income per tax return will be $27,920. So this is the number that's going to be at the bottom of page 1, Form 1120. And so the actual federal tax that's going to be calculated is $5,863. That's the tax we're going to owe for the current year, not $4,813. So let me go back to the 1120 here just to show how some of this ends up on the pages. So page 1, right, we have the sales and we have all the various expenses here. But remember, the expense, that $5,000 bonus accrual, is not going in here because we're not being able to deduct it for the current period. So if we leave that off, the taxable income is going to be $27,920, right? That's this number down here, $27,920. And then the current federal tax at 21% is going to be $5,863. That's what we've got here. Okay, so now we go down to the Schedule L, just so we can see how Schedule M1 is looking. So Schedule M1, so we have the federal income tax per books, right, $4,813. We have the M1 adjustment for the temporary item, right? In item 5 here, we have expenses that are recorded on books, but they're not deducted on the return. Okay, so again, this is an expense that was deducted on our internal financial statements, but it cannot be deducted on the return this year. It's a temporary item. So our net income or loss per books, $18,107, and then the taxable income is $27,920, right? So let's go back to our worksheet, right? So this looks familiar here, right? Our net income or loss per books, $18,107. That was our corporate income tax expense. And then the net income per tax return is going to be $27,920. Okay? Now, how does this all get? Now, so we've kind of shown how these numbers get planted into M1, but just so we can get some sense around how the financial statements are moving, what does this look like on the balance sheet? So on the balance sheet, you have to record the total provision, right? The current and the deferred expense. So the first item, again, we have taxes payable, right? That was the $5,863. That's what we're actually cutting a check for during the period because that's our current taxable income. But you remember down here, our total income tax expense was $4,813. So where do we make up the difference? Right, and that's the deferred tax asset. So anytime you have a temporary adjustment that increases your taxable income during the year, you're going to have a deferred tax asset. If you have an adjustment that goes the other way, right? So if you have a temporary adjustment that instead of increasing your taxable income, it decreases it for the year, you're going to have a deferred tax liability. So in this example, we have a DTA. Up here, if we had a temporary adjustment in the other direction, we would have a DTL or a deferred tax liability. Okay? So before we go to the journal entry, let's look at a reconciliation down here. So when you have the tax provision reconciliation, at the end of the day, you want us to get back to whatever the corporate income tax expense was computed on pre-tax net income. So we have our total federal tax expense, that was the $4,813. Our current tax expense, $5,863, right? That's the check we're actually writing for the year to cover the current federal tax expense. And then we have the deferred tax benefit of $1,050. $1,050 is 21% of the temporary difference. Okay? And so you'll notice how nicely, if we have $5,863 minus the benefit of $1,050, we get back to a total tax expense of $4,813. Okay, so there's a lot to cover here. It might seem a little complicated, but if you watch the video again and look at the example, I think it'll help slowly piece together. I want to keep it very, very simple for this video because these provision computations can get very, very complicated. You could have 100 different temporary differences, both going in either direction, right? Temporary tax benefits or deferred tax expenses. And then of course you get into the whole state provisions too. But in this example, just to highlight kind of how this is working, we just have one temporary difference, which is increasing taxable income for the year. So we have a current tax expense of this amount, and then we have a deferred tax benefit for the piece that's going to be eventually deducted in the following year. Okay, so these are the computations. Now what's the journal entry? So remember, this is the balance sheet after the journal entry was posted. So when you're first looking at this, you're not going to have the DTA, you're not going to have the taxes payable account, and you won't have the amount of tax expense recorded on the P&L either. So the journal entry, to get this provision booked, you want to debit deferred tax assets, $1050, debit corporate income tax expense, that's the profit and loss, the income statement account, income tax expense for $4,813, and then credit federal taxes payable for $5,863. Right? So again, that's the liability, that's the check that has to be written. This is the total tax expense for the year that's recorded on the profit and loss statement. And then in order to get the whole thing to balance, we've got to have our deferred tax asset account of $1,050. So if we look at our Schedule L here, this is our adjusted Schedule L per books. We've got the cash account. There's our $1050, our deferred tax asset. We've got the $5,863. That's the current taxes payable. $5,000, that's the bonus accrual, right? Remember, we booked an expense and the accrual for the bonuses that haven't been paid out. And everything foots down, right? We have $64,070 in total assets and total liabilities and equity, okay? So, so that covers it. I mean, it's a lot to absorb when you haven't done one of these before, but I think this is a very good, simple example to learn on just so you can see how the provision works and how these pieces move around and ultimately get adjusted on the tax return. So, thank you for watching. If you have any questions, please leave me a comment below, and I look forward to seeing you again soon. Thank you.